TSMC just posted 36% year-over-year revenue growth, yet the financials reveal a business quietly battling a massive internal squeeze. But does this mean the market is entirely wrong about TSMC, or is there a hidden fundamental cost Wall Street is completely ignoring? High-performance computing revenue delivered a 20% sequential surge, showing the force of the artificial intelligence megatrend. Most analysts focus purely on this explosive top-line metric, assuming TSMC is simply riding an unstoppable wave of AI infrastructure demand as physical data centers fill with cutting-edge silicon. But beneath that staggering headline, smartphone revenue actually contracted by 4%. This disconnect between enterprise AI spending and broader consumer electronics demand reveals a significant fundamental imbalance for TSMC. While headline writers cheer those high-end server chips, legacy consumer hardware like everyday mobile devices and laptops is sitting stagnant. The sheer volume of AI demand successfully masks this sluggish consumer hardware cycle, strictly because massive enterprise customers outspend everyday consumers by incredibly wide margins. This proves the enterprise shift is entirely rewriting internal financial dynamics. But to fully grasp how this highly complex company handles rapidly shifting demand, we need to look at the colossal cost of building massive physical foundries. The company just delivered an exceptional gross margin of 67.7%, showcasing unparalleled pricing power perfectly baked into their production costs. At first glance, the crowd assumes TSMC will easily maintain this historical profitability forever. This 67.7% gross margin reflects the incredible efficiency of established domestic facilities, where optimized supply chains run flawlessly. But management explicitly warned of structural margin dilution stemming from the rapid expansion of overseas fabrication plants. TSMC is building massive multi-billion-dollar semiconductor fabrication facilities in entirely new geographies. These international factories operate at a structurally higher cost basis, requiring localized supply networks for specialized materials and significant investments in regional power generation. Building duplicate supply chains abroad erodes domestic efficiencies, which becomes obvious when examining the phenomenal operating margin of 60.3%. This 60.3% operating margin acts as a vital financial shock absorber against the inevitable cost overruns associated with global facility construction. The true driver of this valuation is leveraging that operating margin to successfully fund a massively expensive global supply chain without breaking the foundational business model. Once you grasp this, you will look at these massive overseas projects in a completely new light. And this brings us to the real elephant in the room regarding those expensive manufacturing facilities. Operating cash flow was exceptionally robust at 783.4 billion new Taiwan dollars, indicating high-quality earnings generated directly from core operations. Pundits fixate on the massive cash TSMC generates daily from selling silicon wafers. Yet, despite that massive operational inflow, free cash flow actually declined sequentially by 60.9 billion new Taiwan dollars. How does a company mint that much operating cash and still see the actual cash left for investors drop so severely? The answer lies in aggressive capital expenditures, which are now tracking at a monumental $15.7 billion for the quarter. TSMC vastly outpaces historic cash generation to buy heavy physical infrastructure, specifically extreme ultraviolet lithography machines and raw construction materials. A highly profitable market leader like TSMC must continually outspend its own success just to maintain its technological moat against rivals like Intel Foundry and Samsung Electronics. Both competitors are fighting fiercely to capture the next wave of advanced chip fabrication contracts. While the public fixates on gross cash entering the building, the core mechanism here is a $100 billion multi-year infrastructure investment strategy intentionally squeezing the cash actually available to long-term investors. But to understand why TSMC willingly burns through operational capital, we must examine the exact technology they are building. The newly introduced 2-nanometer node is already contributing 3% to total wafer revenue. At first glance, a modest 3% might seem like a simple rounding error, leading casual observers to assume the newest microscopic chips are struggling to gain traction. When you realize how quickly TSMC transitioned this complex architecture into scalable revenue-generating products, that number represents a remarkably fast monetization cycle. Furthermore, advanced nodes now comprise an overwhelming 77% of total sales. This crucial figure means the vast majority of products leaving TSMC shipping bays are not legacy chips, but the most advanced computing units on the planet. These nodes directly power the massive neural networks defining our current technological revolution. This rapid adoption cycle reassures us that TSMC retains absolute pricing supremacy over its most demanding technology clients. They prove top-tier enterprise clients willingly absorb premium pricing for next-generation silicon, reinforcing the ultimate pricing power of the business. Yet even with absolute pricing supremacy, a specific working capital metric demands our immediate attention. Days of inventory increased sequentially by 7 days from 80 days previously, reaching 87 days of inventory. The standard consensus view interprets rising inventory levels as a bright warning sign of slowing consumer demand or physical supply bottlenecks. Casual investors assume unsold silicon sitting in warehouses automatically means the AI boom is stalling out. However, management attributes this buildup directly to the strategic production ramp of the new 2-nanometer node rather than broad market weakness. TSMC is essentially stockpiling wafer components and raw materials to ensure a flawless operational rollout of their most advanced technology. Institutional players will scrutinize this 87 days of inventory metric closely to ensure it genuinely precedes future finalized sales. Additionally, we must factor in that an enormous 78% of revenue comes directly from the North American market. This heavy geographic reliance leaves TSMC uniquely exposed to regional policy shifts and global supply chain realignment. The real insight here is that rising inventory is actually a necessary operational buffer for company. This strategic stockpile allows them to rigorously serve that heavily concentrated North American client base without facing local disruptions. So, returning to our critical initial question, does the current financial situation mean the market is entirely wrong about TSMC, or is there a hidden fundamental cost relentlessly squeezing the business? The truth is that TSMC consciously trades away short-term free cash flow and peak margins to securely cement its undisputed global monopoly. While staggering capital expenditure requirements and the expansion of structurally expensive overseas facilities inevitably cause a gradual profitability contraction, the foundational business fundamentals remain absolutely ironclad. By dominating the advanced node market, TSMC perfectly protects its technological moat by seamlessly passing immense research costs onto premium technology clients. For the highly rational investor, the current market valuation is absolutely not a dangerous value trap. Rather, it reflects a long-term compounding machine undergoing its most aggressive physical infrastructure build-out in modern corporate history. The temporary squeeze on free cash flow and slight margin dilution are simply the required prices of maintaining a perpetual competitive advantage. But I really want to hear your take. Do you think the massive spending on overseas foundries is a brilliant defensive moat or a long-term drag? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.